Hey guys, welcome back into another video. My name is Matteo and today I'm very excited because we're gonna talk about real estate and why I think real estate is an overrated asset class and essentially the reasons why I stay away from real estate because I think there are better ways to invest your capital, and let's get started. First of all, let's try to understand why people really love real estate. And there are multiple reasons why common investors go into real estate. The main reasons, I think, when you ask people about real estate, they think about appreciation, they think about a real asset that they can see and touch, and they think about rental income and stability. And also, real estate compared to other asset classes is probably one of the easiest ones to understand, even for common people, because you buy an apartment, you buy a house, you see it, you can touch it, and you can get rental income from it. So it's quite easy to understand, right? So these are the main reasons why people go into real estate and think about real estate when it comes to investing. However, I want to challenge this perspective and show you all the risks involved into real estate investing and why I think this kind of asset class doesn't make sense in today's age, especially for young people that want to start building their wealth. So yeah, let's get started into the video. First of all, quick disclaimer, of course, this is not any kind of financial advice. This is just my personal opinion. And don't take this as financial advice. So let's get started on all the reasons why I think real estate might not be the best asset class. So first of all, when you buy an apartment, a building, or whatever kind of real estate, there is a substantial amount of operational effort you have to put in. So let's imagine you buy an apartment and you rent it out. You are in the middle of the winter and the heating system breaks down. You either need to fix it yourself or call people to fix it for you and pay thousands of dollars to fix it. Okay? And that not only requires money that cuts into your profits, but also requires a lot of hours and a lot of work on your end. Always make sure your apartment is doing okay is something that needs hours. And I don't like this kind of operational extra work you need to do because, it takes time and it also cuts into your profits. So with apartments and buildings, there's lots of operations going on. And yeah, you have to consider this if you go into real estate investing. Number two, and this is probably what I think is the biggest risk in real estate, and is the risk that people often seem not to consider, which is concentration risk. So when buying an apartment, you have to put, in most cases, a substantial amount, if not all your capital into one single property, one single asset. And I see this as a huge concentration risk. So let's imagine, for example, you have $200,000 saved up and you decide to start investing. You may decide to start with real estate because you think it's a safe, golden asset class, and then you put all your money into one single property. And that property stays in a specific neighborhood, in a specific city. So you're hyper concentrated. Let's imagine the housing market demand in that city collapses in the next year. Well, you have all your money tied up there. Or maybe the demand in the city stays the same or even grows, but in your specific neighborhood, it collapses. Well, you have all your money tied up on that single property. You see, there's a huge concentration risk when it comes to real estate investing. And I know you may be thinking, oh, I can just put $10,000, $20,000 down payment, then get a mortgage, and I don't have to invest all my money into real estate. But there comes another risk and another problem, which is leverage and debt, okay? So if you see across YouTube and, all the gurus out there, they all talk about these real estate investing strategies that seem to be golden, right? But at the end of the day, all these strategies include leverage, include debt. And that is a risk factor you have to count in, okay? Of course, debt can be really bad when it comes to credit card debt, or could be a healthier debt when it comes to mortgage debt. We want to buy a house using debt and get rental income. However, it's still risky because remember that leverage and debt amplify both your gains and your losses. So if the markets start collapsing, well, leverage just amplifies that, right? Again, concentration risk when it comes to real estate. And if you think you just need a small amount of your capital, you're still very concentrated and you get another risk into your investing, which is leverage, right? So always be careful when, getting to that. It's not for everyone And yeah, it's another risk factor to count in, okay? Don't think about all these strategies that seem easy into real estate, because they are not. And even if you get into debt, you have lots of operations going on in order to make sure your strategy performs. Another thing when it comes to concentration risk is also, natural disasters, right? Let's say your property gets hit by a tornado or whatever natural disaster. Yes, there are insurances for it, but insurances cost. Okay, so you have to count all these things into factor, and we'll see later why other asset classes don't have these problems actually. Risk number 3 or number 4, if you want to already consider leverage and debt risk that we have touched upon, is liquidity risk. And liquidity risk is a kind of risk that common people do not think about when it comes to real estate. Okay, if you are into other asset classes, as we will see later, for example, stocks, you understand that when it comes to real estate, you have a big liquidity risk. So what I mean by liquidity risk. So when it comes to real estate, let's imagine you want to exit your investment, you want to cash out, either because you are at a profit or just because you need your money for, emergency or whatever. You cannot sell your property instantly. Guys, this is a big risk, okay? So I don't know if you realize, but when it comes to real estate, you need to find a buyer for your house. So, for example, when we are talking about stocks, you know precisely what is the value, the market value of your stock, and you can sell it instantly, right? During the trading hours from Monday to Friday. Whereas with real estate, yes, you can have an understanding, you can have an estimate of the value of your home, but actually you won't know until you close the deal for your property, right? Because you may want to sell your property at a high price where you don't find a buyer, and this essentially leads to misvaluation of your asset and also months to exit your investment. And I don't like asset classes where I need months to exit your investment. I mean, I could like them if they give me outstanding returns, but we'll see later what are the average returns in real estate market over the decades, and they're not as good as you think, right? When it comes to liquidity, you need to find the buyer that matches your ask when it comes to selling your property. That takes time, okay? Another operational work. Or you may hire a real estate agent, but guess what? Real estate agents' fees are not cheap, and that cuts into your profits, into your investment, okay? But besides money aside, it takes time, right? It takes a lot of time actually. On average, you need at least 1-2 months to sell your house, right? If you put it at the right market price. But it's very common to see real estate owners, when they want to sell the property, being attached to the property, and they want to sell it above market price. If you want to sell it above market price, either you are extremely lucky because you find a fool that wants to buy your property at a price that it's not the current market value, or you need to take months and months to realize you're not selling, you need to lower the price, and then you just wait a lot of time and hours and operational effort. So liquidity risk for me is huge, again, with concentration risk. And it's something I personally don't like. Risk number 5 is non-payment from tenants. And it's quite common to hear stories about tenants not paying anymore the rent, right? And this is a very inconvenient situation because it may take you months or sometimes even years to get your money back and to be able to start getting that rental income again, okay? And this involves hours and hours of unpleasant work to, get your money back and get new tenants. And this is a risk, guys. It's happening more and more that sometimes people cannot afford rent anymore, and real estate owners face this risk, okay? This varies, of course, country by country, laws by laws, but it's something you have to keep in mind. Risk number 6, you cannot dollar cost average into a property. I think you are familiar with a dollar cost averaging strategy, which means buying a fixed amount, let's say fixed dollar amount of a certain asset class over a long period of time. If you want a dollar cost average into a stocks ETF, you might buy, $1,000 of a certain ETF each single month. Well, this is something you cannot do in real estate because once you commit with the price, well, that's the price, and this exposes you to market timing risk. And if you are a good investor, nobody can predict the market, nobody can do market timing. And so when you're committing to buy a house, you may be bidding at a high price, right? And you cannot average your entry point. You just need to agree on the price. If you're a very good real estate investor, you might get exclusive deals with very good prices, but that's not for 99% of people. So again, you have a market timing risk and you cannot dollar cost average. And this is, to me, another risk factor to count in when it comes to real estate. So to be a good investor, it's crucial to assess all the potential risk of a certain asset class and then the expected return you can get from the asset class. So counting all these risk factors in, I would expect 20% at least return on capital from real estate year over year. Like, this is the kind of return I would seek if I were to invest into real estate, counting all these risk factors. But actually, if you see this chart, you can see the annual asset class returns by decade, and you can see that real estate from the 1930s to the 2020s, so over 100 years of period, has averaged out 5% return per year, which to me, it doesn't make sense, guys, okay? Yes, you can hear stories of people getting outstanding returns on real estate, but those are outliers, right? We want to seek the numbers. Numbers speak truth, right? So we want to see global big averages to know what to expect. You cannot take as example, a random guy on YouTube making, 50% year over year on real estate, or, your neighborhood doing a good real estate investment, right? We want to be in the top percent of investors. So this is the average return per decade. You can see that in 2020s, it has been higher, so 10% actually. And we have seen, this across rents in all major cities in Europe and in the US. But, I want to see the numbers on a long period of time, especially for real estate. That is something you want to buy for the long term, right? You're not in real estate for quick money or quick gambling, right? So 5% average return across 100 years for all these risks, guys, to me, it really does. Like, the more I think about this, the more I say, okay, I'm going to stay away from real estate. Either you have a true passion for real estate and houses, but otherwise, guys, to me, it doesn't make sense at all. But I want to make an exception when it comes to real estate investing. And the exception is you could look into real estate investment trusts. What are these real estate investment trusts? So real estate investment trusts are funds that own and manage real estate properties from commercial to residential properties, giving you exposures on both. It's very liquid because it's trading into the stock exchange. So you can buy and sell during the trading hours, which is something I like and gives you liquidity, which is very good. It gives you diversification, thousands of properties all over the world, and also you do not have all the headaches of direct ownership and operational efforts you would need to manage your own properties. So this kind of asset class gives you exposure to real estate without being too concentrated, with good liquidity, and also without the need to manage the underlying properties. So this kind of financial instrument, I think it's very interesting. So you might want to look into this if you are into real estate. Okay, guys, now I want to show you what I think is a better alternative to real estate, factoring in all the risk we have talked about, essentially an asset class that has lower risk and higher returns. And I want to talk about stock ETFs. For example, the MSCI World, the S&P 500, and many more. So first of all, stock ETFs give you diversification. When you're investing in a share of an ETF, you're actually getting exposure to hundreds or thousands of companies worldwide. Think about an ETF tracking the MSCI World Index. Your money is diversified across thousands of companies worldwide, and you get a global exposure, right? So even if a country is not performing well, you have multiple countries of exposure. And this is something I really like. And also you can access those ETFs with small amount of capital with what you have. Second of all, you don't have liquidity risk because you can buy and sell stocks and shares of an ETF instantly during the trading hours. This is possible thanks to market makers that make the financial markets and the stock market, for example, very liquid. So you can get in and get out whenever you want instantly during the trading hours from Monday to Friday. And this is, guys, to me, very, very important, like really important. I want to be able to get in and get out whenever I want. And I would say it's not infinite liquidity, of course, because there's a price impact to it. But like for retail investors, it's kind of infinite liquidity, right? You have to think about liquidity just if you're a big fund with, millions or even billions of dollars that you want to put into a specific ETF, then you might have some liquidity issues, but it's for average investors with even some couple of millions of dollars, it's not a problem. Number three, you don't have any management hassles, because when you buy ETFs, you don't have to manage anything essentially. You just hold your share and get out when you want. Of course, if you start doing trading, which I don't recommend because nobody can time the market, and there are professional trading companies, very sophisticated in the world, that can do trading, but it's not for regular investors, okay? I would like to do an in-depth trading series video. Let me know if that's something you want to see. Just to say that there is no management when it comes to ETF investing. You just need to buy, do your dollar cost averaging, and that's it, okay? Yes, build your strategy, but there's no management. There's no something that's, that breaks down, or like in the apartment, or tenants not paying, and this leads me to point number 4. So you don't have the risk of tenants not paying you. You have diversified to thousands of companies, and a part of them always give out dividends, and so you don't have the risk of not getting rental income. That is the main thing you want to go into real estate. And also, we have already touched upon this. You can dollar cost average, and dollar cost averaging into an asset class has been proven to be golden strategy to successful investing, because you are not timing the market. You are entering a certain asset class at averaging out your entry price, and this gives you, like, over the long term, the best returns. And it's something you can do. There are multiple now brokers that offers dollar cost averaging on autopilot, which means you set a budget each month and you don't even need to enter the broker to start your dollar cost averaging. And it's very easy nowadays to dollar cost averaging into ETFs. And it's proven to be the golden strategy for investing. I know it's not probably a fancy strategy, but it's the strategy that actually work. And we want to be a successful investors, right? That's why we are here, and we are talking about how to invest successfully your capital. And probably most importantly, so you don't have all these risks. Yes, in the stock market, there are other risks, but I would say real estate risks are way bigger and way higher, in my opinion, all the ones we have talked about. And what is the return, the average return you can get from stocks and from ETFs tracking, for example, the S&P 500, let's say. In the chart that we already seen before, you can see the average return over 100 years of the stock market, and that has averaged out 10% per year. So in my opinion, you can get double the return for half of the risks, or let's say way more risks than real estate and way higher return. And this has been proven by the numbers. This, guys, for me tells it all, right? So again, let's make a practical example. Let's say you have 200K saved up. Okay, you can make this assumption with any amount of numbers, right? Let's say you have 200K saved up, and you have to decide how you want to start investing, right? And the two options can be stocks with ETFs tracking a global indexes such as the MSCI World, and on the other hand, you may be thinking about going to real estate. So if you decide to go into real estate with 200K, you probably need to put all your capital into one single property. So you have super high concentration risk on a specific city, on a specific neighborhood, and in a specific country. It requires to you ongoing management for property. You have potential tenant risks, people not paying you the rent. You have liquidity issues when you want to exit your investment because you need to find a buyer, and you do not have a precise, until you find a buyer, market valuation, because it's demand and offer that at the end of the day speak about the market price. Or maybe you may be thinking, no, I can just put 50K down on the property and get into debt to buy the house. Well, for sure, but you have another risk, which is leverage, and that is debt. So if things don't start not going well, debt and leverage put you in financial troubles. And also right now, the interest you have to pay to pay off your debt is way higher. It's double what it was some years ago. And case number two, you may decide to use that 200K to go into ETF investing. So you start a dollar cost averaging strategy, which you cannot do with real estate. So you may decide, for example, to invest, I don't know, 10K over the course of 20 months. So almost like in 2 years, you spread out your average entry point. So you may be buying months where ETF is trading at a high price, at a low price. And if you hold the investment for years, that will prove to be a successful strategy. I'm not saying this. Numbers can show you this. Also, you're very diversified because you are exposed to multiple countries, thousands of companies, and yeah, so you're way more diversified than if you were to buying a single property. You don't have liquidity issues because you can get in and get out during trading hours every week, essentially, instantly. So no liquidity issues unless you have billions of dollars in assets under management. Guys, I hope you understand what I'm saying, but I'm curious to know if some of you guys are really into real estate. If I have missed something into my analysis, I'm happy to hear from you. I'm happy to hear from real estate experts. But from my experience and for all the reasons we have touched upon, stocks ETFs are way better than real estate investing. And I don't see the point to real estate investing unless you have millions of dollars in assets to your name and you want to diversify, of course, into multiple asset classes. So you want to have stocks, real estate, bonds, crypto, and so on. That could make sense. So if you're looking to grow your wealth efficiently, you may reconsider traditional real estate investing and explore better alternatives such as ETFs tracking global stock indexes. So I hope you guys really enjoyed this video. It was, for me, really interesting and fun to make. If you want to see more content like this, please leave a like and share it with your friends. Always don't forget to subscribe so you can get notified when I post a new video. And also let me know in the comments what you think about real estate versus stock. I want to hear your opinion and let's engage into the comments and yes, let's start a discussion and I'll see you on to the next video.